Assalamu alaikum friends, welcome to lecture 17 of SBL, and this is the part 3 of strategic choice. One request that before watching part 3, please do watch my previous two lecture, which is part 1 and part 2 of strategic choice, which is your lecture 15 and 16. Okay, and then I would advise you to come to this lecture. And the good news is that this is one of the last lecture in your section C. That is under strategy, this is your last lecture. Because after this, the next lecture will be on risk. Okay, which is section D of your SBL syllabus. So let's start with the remaining portion. In my lecture 15 and 16, that is part 1 and part 2 of this video, I have discussed the top 4, that is competitive strategy options, how to sustain competitive advantage, the growth strategies, that is the ends of matrix, product development, market development, diversification, and market penetration. Then we went through the SAF model, that is suitability, acceptability, feasibility. In this lecture, we are going to focus only on methods of strategic development. Okay, so let's start with number one way that an organization can grow or develop is how? Through acquisition and merger. Okay, so let's read the advantages and disadvantages of acquisition. Okay, acquisition is when a powerful company takes over a company, a smaller company or a weaker company, okay, known as a target company. That is the meaning of acquisition. You buy over your rivals. So what are the advantages? One advantage is this is the quickest way to grow. Okay, provided you have the finance with you to source the accusation, to fund the accusation. Second, but remember, disadvantages on the other hand of this is it could be expensive. It's not easy. You have to have a large amount of finance. Accusation does not come free of cost. Second advantages is synergy gains can be there. Okay, for example, you and your competitor whom you are taking over, acquiring, might be having common employees or common technology, so you can get the synergy gains, economies of scale. Okay, next, disadvantages on the other hand, could be a disadvantages. Okay, see, advantages could be taken as a disadvantages also. Like synergies are not automatic, you have to work for it. And working means, for example, it's not always easy. The culture might be different. One party might not accept the other party, things like that. Then acquire the necessary strategic capabilities. For example, the firm whom you are taking over might have the technology that you don't have access to before the accusation, or they might have certain resources which you can take over. Second, this can lead to cultural clashes. They might not want to give up so easily. Okay. Then overcome barriers to entry. Yes. Through acquiring, you overcome the barrier to entry. But there may be legal barriers. What is it? Competition law. Government might stop the accusation from going ahead because they think if you acquire your rivals like this, keep on acquiring, you will become very powerful or maybe a monopoly one day. So government wants to keep competition in the economy so that goods and services are competitive, they are of the utmost quality, and customers are protected by this. Okay, so legal barriers might stop the accusation from going ahead. Then they can choose a target that fits best. Okay, whatever you feel, whatever the target company is the one which is being taken over, which has been acquired. Okay, it is known as target company. So target, whichever target suits you best, you can decide on it. Okay, but on the other hand, all parts of the target are acquired. You are not taking them in parts. The part which is good I will take over, the part which is not good I will not take over. It's not like that. All the parts of that target company you are being acquiring. So what is the problem? Even its problem will come along with it. Best thing is, okay, even the problems will come along with it and you have to take care of it. Enhances reputation with finance providers. What finance providers like banks, the one who's going to give you loans. Okay, for in their eyes your reputation is enhanced because you acquiring means shows that you are in a profitable condition, you are a big company, right? You have the finance available to pay back the finance providers. But disadvantages is it requires good change management skills. Okay, because you are changing totally, you're acquiring, so you have to manage the change. Now let us go to the sources of synergy. There are three sources of synergies. Okay, number one, Okay, we'll see. Before that, we'll see what is synergetic gains, the definition of it. Synergy means when two companies combine, their value, the combined value is more than the value of the two companies separately. Understanding? It's like 2 plus 2 is equals to 5, not 4. That one extra is synergy benefit. Okay? This can come from various reasons. Maybe profitability. Okay, the combined profitability is more, financial position is better, our market position. Okay, so one is combined profit. Why combined profit is higher? Due to some reasons. Let's see why. One is sales synergy, or you can say revenue synergy. One type of synergy is known as revenue synergy. Okay, how? Because you are sharing databases. When you acquire, you are sharing databases. You are selling products which are complementary. Complementary means it's like when you have a car, you need a petrol or you need a diesel to drive the car. It's complementary. One comes with the other. They need to work hand in hand. So selling products which are complementary. Maybe you are into a product. Let's say you are the automobile industry, and the firm that you are taking over is in the petrol industry. So it's a complementary. And you are sharing the distribution channel also. Because of this, you are having a synergy in the sales. Sale increases means profit will increase. Okay. Next, cost synergy. So these two reasons will help you to achieve higher profitability. One is sales synergy. With that cost synergy also you need. Cost synergy means your cost is now lower because you are sharing staff. You have to pay them low salary. Okay, excess staff you can lay them off. You can gain economies of scale. You are sharing the premises. Even the central service like accounting, finance, you are sharing. So cost synergy also we are achieving. Sales with the cost synergy will give you a combined profit higher than it is individually of the two companies. Next, we have sources of synergy. The next one is financial position. Why the financial position of the combined company is better? Due to this reason. Because you are sharing assets. Excess assets you can sell off. Let's say both you and the target company both have the same type of assets. Sell off the excess because now you can share the assets. Second, using assets better. Third, share the working capital management. Fourth, cheaper financing is available. Now you can find cheaper financing. Then, stabilizing cash flow, removing seasonality. Okay, so through this, your financial position can be improved. This is of the combined company we are talking about. Next, we are moving to improved market position. How your market position can come. Market position can come from this fourth areas. Either you are sharing skills or knowledge. Risk is reduced because of portfolio effect. What is portfolio effect? You are having more goods. Okay, you are having the demand from the target company's customers also. Okay, so now your risk is divided not only in your business but also in the target company's business. So risk is reduced. Improved management, better corporate parenting. We are going to study what is corporate parenting after a small question. Test understanding one. Okay, and then we have better focus. Okay, so all those things will improve the market position. Now, before going to corporate parenting, let us do test your understanding one. Test your understanding one. Okay, this question is regarding accusation. First, we'll see what is the requirement, as this is always the first thing that one needs to do in the actual SBL exam. You first need to read your requirements before you read the case study. So you outline the issues to be considered when assessing the accusation. How do you answer this question? Looks like a very open-ended question. Which model to use? How to answer this question? Very simple. Whenever they say evaluate whether the strategy is worthwhile or not, or assess the accusation, use this model. SAF model you have to use. That's what they are asking. What does SAF stands for? S stands for suitability, stands for acceptability, F stands for feasibility. You have to use this model simply. Okay. So now let's read what's there. Blueberry is a quoted resort hotel chain based in Europe. What it is? It's quoted resort hotel chain. So it's in a resort. That means it will be having seasonal business. Okay. What can you imply from this? Because it's a resort hotel chain, it will not be used throughout all the year. Okay. Seasonal. Now let us read the industry and the performance. Whenever, even in your actual SBL exam, information will be more. That's the only difference. But this is the way they will give you. Okay, some intro they will give you what it is, which line of business they are into, what industry. Then they will give you the performance of the industry as well as the performance of Blueberry. Okay, what this industry is about. The industry means hotel industry. So the hotel industry is a truly global business uh, characterized by the following. What it is? Number one, increasing competition. You have to take care of these things when you write your answers. This industry is increasing competition. Second, an increasing emphasis on customer service with the higher standards being demanded. Third, in particular, the range of facilities, especially the spas, is becoming more important as a differentiating factor. They want more customer service with higher standard, and spa, which could be a differentiating factor, and competition is increasing. Now let us go to the performance. Blueberry offers service at the luxury end of the market. Which market? Luxury end. So you cannot say it's a low cost. So in a differentiating factor. Okay. Based on a strong brand as well as a prestigious hotel. But its reputation was tarnished over the last 5 years due to variable variable customer satisfaction levels. Variable means sometimes the customers are satisfied, sometimes they are not satisfied. It keeps varying. That's why the reputation suffered over the last 5 years. So there are some pros and there are some cons. Second, despite a reputation for having the most prestigious coastal resort along the Mediterranean in 2000, Blueberry was a loss making in the financial year. The 2 years. Out of the 5 years, okay, their reputation was over the last 5 years tarnished. Over the last 5 years, out of it, 2 years they were in loss making. Correct? But to some extent, this situation has been turned around in 2006-7. That means in the third year with an operating profit of 11 million. Okay. However, shareholders are putting the board under pressure to increase profits and dividends further. What is the shareholder pressurizing? One is to increase profits, second is to dividends further, to pay more dividends. Now, one more is there. Yeah. Next is management has responded to this by setting out an ambitious plan. How management is going to go with the pressure? By having a plan. What is the plan? To upgrade the hotel facilities throughout the company and move to more up market. So because of this, it's not easy. You want to move to the up market, you want to upgrade the facilities, you need finance. So the bulk of finance is planned to come from how? From retain. Always check the source of the finance, where you are getting the source of finance from, because this is very important when you need to write an answer, especially for an accusation. Source of finance. Okay. So they are planning that they are going to use bulk of it from retained profit. Why? Because as Blueberry has historically kept its financial gearing low. Financial gearing low means what? They have used equity more than debt. Debt is less. Okay. Now come to acquisition opportunity. Management of Blueberry has been approached by the owner of the Villa Diosti, a luxury hotel. This is also a luxury hotel on the shores of the Lake Como in Italy, who is considering selling it. The owner wants to sell it to the management of the Blueberry. So the hotel has an international reputation with a world-class spa facilities and generated revenues throughout the most of the year due to their mild microclimate. The asking price will be approximately 50 million US dollar. Asking price means the acquisition price that Blueberry needs to pay to the owner of the luxury hotel to get it. Now you need to consider the issue. Before actually going through the answer, I want to spend a few minutes to tell you how to break this answer down. How to know where to start, how many points to make exactly. First of all, we don't know how many points to make because it depends on the number of marks. Here the marks are not given to you. Okay. But if you see, you need to divide it in different paragraphs with different subheadings. Subheadings are your suitability, acceptability, feasibility, and your conclusion. So 4 subheadings will be there. One is suitability, one is feasibility. This can be in any order, by the way, and the other one is acceptability. With this comes your conclusion, or you can say some recommendations, preliminary recommendations. It could be anything. You can write conclusion or recommendations or anything. Recommendations are usually at the end, and it will always be not written so much in detail. Okay, briefly, just 2 or 3 points. Now, first we are going to break down suitability. There are four answers for it because I can see from different paragraphs. Okay, avoid bullet points in your answer. Okay, don't write it in bullet points, write it in different paragraphs. So the first one is, when you talk about suitability, okay, let me tell you how you write. Mostly it depends on the information that is mostly given to you. What is the first point that is given regarding Blueberry, regarding the hotel industry? Increasing competition. So increasing competition is something which you can write in the suitability. Why? Suitability depends on the model that you have used, like Pestel and Porter's five forces. So Postal five forces talks about competition. Use this competition part in your suitability answer. You need to know which part goes under what. Like, does it fall under suitability? Does it fall under feasibility? Does it fall into under acceptability? You need to know this. One needs to know it. You cannot write this factor under acceptability or feasibility. This comes under suitability, the competitiveness. So that's why we are going to talk about the competitiveness. Okay, second, how it addresses or does not address the problem of the company. So first one is competition. Second is whether it addresses the issue of the company that they are facing or not before the accusation. Third paragraph. Okay, whatever resources or capabilities they have, just talk about it, how they can fit with their current strategy, whether it's a good fit or not, whether they are suitable or not. If you see here, they are saying that they have a range of facilities, especially spa. Okay, somewhere they have written that they have world class facilities are there, international reputation for world class facility. Okay, and that is a differentiation factor in the industry also. So isn't it good for you? It's good for you. So you're going to talk about world class spa. And the fourth one is, you are going to talk about goodwill. Okay, because they are talking about reputation. Whenever they talk too much about reputation, they have good reputation, they have excellent reputation. Point is goodwill only, because reputation comes from goodwill only. So these are the 4 points under suitability. It will go always. It's not always only for this time. Whenever they talk about competition, under suitability. Whenever they talk about goodwill, reputation, under suitability. Whenever they talk about solving an issue, whether it has been solved or not, suitability. Okay, so first let's start with the first one. Hotel market is becoming increasingly more competitive. We know that. It has been given in the case study. So if they are becoming more competitive, what is the issue? So it might make more sense for the Blueberry to try to diversify its activities more. This is how you need to say why they need to diversify, because market is becoming more competitive. So it makes sense also if they want to diversify activities more. Who has to diversify activities more? Blueberry. Don't forget the name of the company. Blueberry, 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 Blueberry. Everywhere you have to write this. Even if you have to repeat it multiple times, do it. Second, okay, the accusation does not address their Blueberry's underlying problem. What is it? What is the underlying problem? That they are getting inconsistent customer service level. They're not able to satisfy customers. There's a variability. Can this accusation satisfy that need? No. So accusation does not address it. That means it's not suitable on the other hand. Third, on the other hand, the villa, mention the name of the owner, okay, and write words like on the other hand. This connects your third paragraph with your second paragraph. This is how you use connecting words. You must have learned this in English language and all. Okay, I'm not teaching you your English language and all, but I'm saying connecting words you use, answer becomes more professional and it looks better rather than writing bullet points. Okay, but this is just in your textbook, that's why it's in bullet points. Forget about it. In your actual exam, don't write it in bullet points. Okay, so on the other hand, the owner, they have already a world class spa, isn't it? So if they have a world class spa, it will fit well into their current strategy of moving up market. Blueberry, what do they want to do? They want to move up market, no? So if they want to move up market, don't you think they need a spa that also world class spa? So isn't it good that if Villa Diovesta has that world class spa, so if you go in accusation, you can get that access to world class spa, which will help you to move to up market. Understanding on one side you are supporting, you're saying you're suitable, on the other hand you are saying not suitable, again you're saying you're suitable. And the fourth one is, also the goodwill attached to their reputation would enhance their Blueberry's image. Goodwill for villas will help Blueberry also, depending on the branding decisions. Okay, you can even write a final line also here, which they have not written here. as I told you before, that it is suitable or it is not suitable. Accordingly, you write. Okay, I'm not going to answer that for you. Now we are moving to the feasibility. Whenever feasibility comes, okay, talk about finance. This is very easy to remember where you have to talk about finance, because this is F, this is also F. You see, F, F. F for feasibility, F for finance. This is how you link. So it's very easy. Finance, talk under feasibility. Okay. So financing is how much? Asking price 50 million. Numbers are not try to put in feasibility. So is 50 million easy? You are currently having a profit 11 million. You want to have 50 million to finance. So finance in the accusation could prove problematic currently. Now, when you talked about financing, they talked about gearing ratios and things like that in the case study. Because of that, it's easy for you to divide the finance into two. One is debt, one is equity. This is how you need to break down information and write. Obviously, you don't have to draw a table like this and waste your time, but in your head, you must be knowing, right? That this is what I need to write. You can visualize. So let's talk about debt finance and equity finance. Let's first talk about debt finance. They told historically financial gearing is low means their debt is low. Okay. So what happens? Now, if you want to say that you want to increase your gearing, the shareholders may resist it. They do not want to, because it's a risk for them also. Then equity finance. So given the losses in 2 out of the last 3 years, you see how you're linking losses with your given equity finance. Losses has been 2 out of the last 3 years. Blueberry may struggle to raise the purchase price via rights. So Blueberry may struggle to raise a purchase price via a rights issue. You cannot. Struggle to raise the purchase price means what is the purchase price? $50 million. Even if you give right issues also, for equity finance, you will not be able to raise this much of finance. 50 million. You will struggle with the losses that has been given. Understanding. Now let us move on to the acceptability. Acceptability also, there are 4 points. Okay, when you're talking about acceptability, you need to talk about whether it will be risky or not, whether it will be acceptable to the shareholders or the customer or not. So mostly you talk about accusation here. Advantages and disadvantages of accusation you can give here. Okay, so growth by accusation is quicker than organic growth. And if this is quicker, satisfy your institutional shareholders' desire also. What was their desire? To see growth in revenue as well as dividend. This is what they wanted. So you go by accusation, may make it faster and quicker to see the growth in revenue. Then further work is needed to assess whether 50 million asking price is acceptable or not. Whether this amount is acceptable, you need to do more work. Okay, this could be a part of an answer. Try to write answers. More work is needed, more evaluation is needed, more justification is needed. Okay, just don't accept the 50 price on the face of it. Just because 50 million is asking price, don't accept it. You have to negotiate and bring down the price. You have to see whether this price is genuine or not. Is it worth it or not? Then only you accept. Third, you talk about all other things like non-financial factor, non-financial advantages. So if you buy another hotel, Blueberry can gain additional economies of scale or not regarding insurance, their staff cost and their pensions and purchasing economies on drink. So because you are getting economies of scale, your cost is going down, what happens? You can boost your margin and profitability further. And then we are talking about cash flow. Remember, here also we are talking about finance, cash flow and things like that. So this new hotel would be a fit well into their existing portfolio. Why? He's in the upmarket hotel, you are also in the upmarket hotel. Okay, so this new hotel will be fitting well with your existing portfolio of hotels. For example, by having significant cash inflows. Why? New hotel, they have significant cash inflows throughout the year. In contrast to Blueberry. Blueberry, do they have? No. Because they are into highly seasonal business, as I told you, coastal area. They are highly seasonal businesses. So, because of this, you are reducing the overall level of risk. Rather than Blueberry being in a highly seasonal business and having a huge amount of risk, if they acquire the new company, they can take the advantages of their new cash inflow. which will reduce the overall level of risk. So it shows that this strategy is acceptable, okay, but it is not suitable, and regarding the feasibility, it does not look like so it will be feasible. So even if it's acceptable, it's not feasible, and this thing. Okay. So now preliminary recommendations or recommendations. What is it? Recommendations means whether you have to accept or go ahead with the accusation. That's what it means. So opportunity to acquire should be rejected. Why? On the remember, whenever you say should be rejected, don't stop there. You have to say on the grounds of this or that. Why you rejected it? On the grounds of financing that accusation. There are so many points that you've explained under suitability, feasibility, acceptable. Which point you need to write here? You need to have a very good judgment on that. Okay? Because financing is difficult. Even if everything else is in favor, financing accusation 50 million is very difficult. So reject on that financing basis. And second, Blueberry should instead focus on what? On improving facilities and quality in the existing hotels before looking to expand through acquisition. They're having issue in their facility, in their quality, in the existing hotel. How can they go and expand? Before they expand, they have to improve on these areas and make it work so that customers are satisfied throughout, not variable. Variabilities are not there. Okay. So that's it for test understanding 1. Now we are moving on to the parenting, corporate parenting. Okay. Corporate parenting. What is corporate parenting? Corporate parenting looks at the relationship between the head office and the individual business units. Okay. This is usually suitable for those where you are acquiring a subsidiary. Okay. So it's very important that you become a good parent to your new subsidiaries. Okay. So you can say that corporate parenting is needed, especially when your route of growth is accusation. Okay. So corporate parents, they do not have direct contact with the customer or the supplier. Okay. But their main function is what? To manage the business unit. It is the business unit. For example, the subsidiaries will be dealing with the customers directly or the supplier. But the corporate parent, what do? They manage the business unit. Okay. So there are some issues for the corporate parents. What are they? Number 1, they can either add value or destroy value. We'll see how they add value. They add value and they give business unit advantages. Okay. Otherwise, it would not be possible if the parents do not support the subsidiaries. Okay, for example, parents will be giving the subsidiaries the resources that they need, the skills, but on the other hand, they can also add cost by destroying the value that business units have created. That means the subsidiaries have created, parents can destroy that value. For example, if the central overheads are recharged to business units. Now, what are the advantages and disadvantages of organic growth? So from accusation, we are moving towards organic growth. Okay, advantages is that it can spread the cost. No cultural clashes or control issues because it's the same culture that you have been following, right? You are internally growing. So there will be not any control issue also. Can be set up in many ways. For example, you can go through a new division also. Okay. Then may get access to government grants. Yes, it's possible sometimes. Easier to terminate. The moment you want to terminate, you can easily terminate. Why? Because it's your own business. Internally you are growing. Okay. Rather than going into accusation and then terminating, because it will then affect two parties. But here it's easier to come out. Can be developed slowly, less risky. Yes, it takes time. The disadvantage is also that it takes time. It's slow, but it is less risky compared to accusation. Disadvantages is lack of experience. Since organic growth, okay, even if it's organic growth, you'll be having lack of experiences in new areas. Then less attractive to finance providers. Whereas we saw that accusation was attractive because it makes you look powerful. That's why you have acquired your weak competitors. But when it comes to organic growth, it looks like that it's very slow, right? Takes a lot of time. So it's less attractive to finance providers. There may be barriers to organic entry. Correct. Then it may be too slow. No access to skills. You might not have access to any new skills or reputation is there. Okay. And managers may be spread too thinly. What does it mean? You are using the same managers. So when you're growing organically, you need the same managers, but their responsibility will increase. You understanding? Rather than having new managers with fresh insights into the business, you're using the same managers and giving them more responsibility. So you're spreading them too thinly, okay, which is likely to break soon, okay, or they might become demotivated and might leave the company. Advantages and disadvantages of joint venture. So first, see the cycle. We started with accusation, then we've moved on to the organic growth. Now another way is joint venture we can develop. So advantages are that you can share setup. Joint ventures are when two or more parties they have control over a asset or liability. That is the meaning of joint venture. Okay, join, the meaning join says you need more than one people. Okay, so you share your setup and running cost. You learn from each other. You focus on relative strength. Okay, everyone uses their strength, and it reduces political or cultural risk, better than going alone and then competing. Disadvantages is this can lead to disputes. As you know that more than one people, even in partnerships, joint venture, you will be having some disputes. Second, you are giving access to your strategic capabilities, but what if that partner competes with you in some core areas? Right? In the future it can happen. Third, there may be lack of commitment from each party. Commitment is not same for all this party. If it's same, good. But in practical world, we know that lack of commitment is there from either party. Could be from any party. Requires strong central support which may not be provided. Yes, both the joint venture, however joint venture, there are two party, three party, they need strong central support that makes them bind together, join them together, but there is not that strong central support for them. And then transfer pricing issues may arise and performance appraisal can be complicated. Okay, because both the parties are jointly contributing, their risks are divided, profits are divided, it's hard to know which out of the two or out of three, whatever, how many are there are performing better. You cannot, it becomes complicated. Performance appraisal. Next, characteristics of a well-structured strategic alliance. What is the meaning of strategic alliance? It's very important that you should know what is strategic alliance. Strategic alliance is, it is not formally, okay, it is like very informal way that you are a cooperative business activity. You cooperate with two or more separate organizations. It's like a group that you're forming. Okay, so here what do? You allocate the ownership, the operation responsibilities, the financial risk, rewards to each member. But you'll be having your own separate identity. How this is different from joint venture? Joint venture, you join together, okay? But here, you each one of them will be having their separate identity or autonomy, the freedom to make decisions. But they will be sharing all this. One example of strategic alliance is, you can say, opaque, right? Where they agree to increase the price. The group of cartel, you can say, that is formed. Together they decide that they are going to raise the prices for the consumer. So it's a example of a strategic alliance. Okay. Now, alliances can, well, let us read more about strategic alliances. Okay. It allows participants to achieve critical mass. When you want to enter a mass market, better to go by strategic alliance. The one who are already powerful, join hands with them rather than you going alone. Because you can benefit from their skills also. And also you can transfer the skills. Then, technical difference. What is the technical difference between joint venture and strategic alliance? Difference is whether the independent business entity is formed or not. Okay, in a joint venture, independent business entity is formed, but in strategic alliance, no. It's very loosely they are connected. And alliances can include things like partnership as an alliance, joint venture is a form of alliance, contracting out services to outside supplier. These are forms of alliances. Now let us move on to the 7 characteristics of a well-structured strategic alliance. How can you say a strategic alliance is well-structured? It should have the 7 characteristics. Number 1, strategic synergy has to be there. That means when you're combined, your strength is more than what it was when you were independently working. Second, positioning opportunity. At least one of you in that strategic alliance should have a leadership position. Okay? Maybe it is regarding technology. You have access to some technology or the raw materials, right? Could be for anything. Third, limited resource availability. That means wherever you are lacking, make sure your partner has strength in that area, and wherever you have strength, make sure Wherever you have weakness, make sure your partner have strength, and it's the opposite. Okay, so that you can compensate for each other. Less risk. When you're forming alliances, it reduces the risk. Then the fifth, cooperative spirit. Both companies are willing to cooperate fully with this. It's not that you are forcing someone, the other party, or the other gunpoint that you should listen to. You willingly, both of them, cooperate. Clarity of purpose is there. You should know what are the results expected, milestones to be achieved, the methods that each one of you are going to do, resource commitments. Then win-win. It should be a win-win situation for all. Okay, the structure, the risk, the operation, the reward, this should be fairly apportioned among the members. Then we have advantages and disadvantages of franchising. So we started with acquisition, moved to organic growth, then joint venture, then strategic alliance. Now we are moving to franchising. Before we move on to partnership, after this we have partnerships. Okay, so advantages of franchising, number one. Before that, I'm sure that you know what is franchisor and franchisee. Examples are, you have plenty of examples: Pizza Hut, McDonald's, Papa John's. You have branches everywhere. Internationally, every country has branches, right? Of Pizza Hut, McDonald's. Why? How is it possible? Because of franchising. So there are two parties to franchising. One is known as franchisor, the other one is known as franchisee. Franchisor is the one who gives his license. He's the owner. Basically, he is the one who started the business. He gives his license to operate, the name, the resources needed to operate under his branding to the franchisee. Okay. So when we are talking about advantages and disadvantages, it includes both franchisor and franchisee. It's like employer and employee. So advantages of franchising: receives an initial capital injection. Injection, what does it mean? See, when a franchisee comes, you do not have to invest. Automatically, capital has been injected by the franchisor. You can just come and work. Then can spread the brand very quickly. We have already seen the examples of McDonald's and Pizza Hut. Then easy to terminate. Easily you can terminate. A good way to test the market before full investment. For this is for the franchisee. If they want to come into the market, they want to see whether it will be successful. It's very easy. They can test rather than going on their own for a full investment. They can test the market by going under the franchisee. Then franchisee may provide better local knowledge. So it is the franchisee who has a better local knowledge of the country than the franchisee. And the franchisor management can focus on strategic rather than operational issues, because the franchisee is now taking over. He is the one who is dealing with all operational issues. Franchisor, what can they do? They can sit and focus on the top level, the strategic issues now. Okay. But what about the disadvantages? Profits are shared between the franchisor and the franchisee. And even your strategic capabilities, when you share with your franchisee, they might take over you. They might starting competing with you. Then lack of goal congruence can be there. Maybe the franchisor has a different goal, franchisee has a different goal. There is a loss of control over quality and recruitment. Yes, it's hard for the franchisor to control the quality. Why? Because they are now losing touch of it. It is franchisee who is in the operational side. Then there is a lack of consistency across franchises. That's why if you have ever gone to Pizza Hut or McDonald's and tasted the food, you will always see some differences between among the branches itself in the same country or in different country. Why is it so? Because there's a lack of consistency. Not all the franchisee will perform the same or can cook in the same way. Differences are there. Consistent, it's not consistent. This can affect the brand name of the franchisee even though franchise is the one who's working. Then we have, it is difficult to attract franchises. If you want to attract the top level franchise, is difficult. It's not easy. So now let us do test your understanding number 2 before we move on to partnerships. Test your understanding 2. So in test your understanding 2, you have been given 3 situations where you have to decide whether joint venture, strategic alliance or franchising is the most suitable. So let us read the first one, okay, out of this 3. A company has invented a uniquely good ice cream and wants to set up an international chain of strongly branded outlets. Look like Pizza Hut or McDonald's is doing, right? So what comes to your mind? What do you think? Joint venture, strategic alliance or franchising? I think it is franchising. So I will write F next to it. We'll see the answer. Next, an oil company which in common with its rivals is under political pressure to develop alternative renewable energy sources. According to me, looks like strategic alliance could be one. And the third is a beer manufacturer wants to move from its existing domestic market into international sales. This is, we'll see. Looks like you can use licensing. So the first one is ice cream. Here, a franchise agreement will work. Okay, because this is the quickest way they can do of expanding in this case. Second, regarding oil company, okay, if there is no need for joint research and development, that means joint venture, then you can go for strategic alliance. Okay, so in strategic alliance, what happens? The research cost and findings will be shared with other oil companies. They can bring powerful pressure on governments also together. For example, by allowing them more generous time scale for the implementation of new technology rather than being in hurry. And also the new energy technology could be developed within a joint venture organization. Okay, and the last one is about the beer company. So almost certainly this company would expand by licensing the local brewing companies to make and distribute its product. You can license so that they can make it in the international market. Okay, so that's it. This is just as easy as it is. Now let us go to the partnership. Why a partnership? Okay, because the aim is to bring expertise together to expand the company's reach, drive growth, and cope with rising competition. Because it's always better to compare with group of people rather than alone. Because each one of the partners have different expertise, which if they are joined together can give a greater benefit. Then co-branding is a strategic marketing and advertising partnership between the two brands, where the success of one brand brings success to its partner brand too. Okay, so this co-branding, it can be effective way to build business, boost your awareness, and break into the new markets. So if you want to break into a new market, if you want to develop, how do you do that? You go into the co-branding where you promote the brand of another partner, will bring benefit to your brand as well. It will bring success to your brand as well. So it's like a win-win for all the players in the game, where both partners need to find value in the future relationship. Okay, one partner's brand will bring success to another partner's brand. That's why it's always good to go in a partnership, even though there are some drawbacks of it, which we should not forget. Okay, now let us move on to our last topic for this lecture, that is portfolio analysis. That is the last section. Portfolio analysis. In portfolio analysis, we are going to cover three models. Okay, BCG matrix, public sector portfolio matrix, and Ashridge portfolio. So, why do we do portfolio analysis? Portfolio analysis is designed to reveal where the organization has too many declining products or services, or too few products or services which has growth potential, or insufficient product or service profit generators. That means profit or service is not able to generate that much of profit that they could be maintained presently for the organization's performance. Okay, or to provide investment funds for the nurturing of tomorrow's successful ventures. So for these three reasons, we have to do a portfolio analysis. Portfolio means where we have range of products and services. That is known as a portfolio analysis. Because not all products and services will be performing in the same level. Some will be lagging behind, some will be ahead, some will be moderate, right? Now, portfolio analysis can be very valuable in assessing how the balance of activities contributes to the strategic capability of the organization. That means how do you keep a balance among this activity? That is the reason why we do portfolio analysis. Now, this is the model that we are going to do. The first model that we are going to do under portfolio analysis is BCG matrix. Okay, and this portfolio analysis, before you apply it, you should know that this should be applied to SBUs, that is strategic business unit. That means units that deals in a particular segment, not the whole market. You cannot say the whole market is performing bad. No, only for a particular segment. And it will result in different targets and expectations for different parts of the organization. So different parts of the organization will have different expectations and targets. Okay, so that means you have to decide where you are going to allocate your resource, both in terms of capital and revenue budgets. Which products or service needs more resource allocation, which needs less. You have to decide. And ACCA has stated that it will not explicitly ask for a specific portfolio tool. They will not mention that use this portfolio tool or that portfolio tool. But you will be okay, but you will expect to use whatever models are most useful in the scenario. Whatever the scenario given to you, you have to use a judgment. What do you think, which model is most suitable? If you feel BCG matrix is more suitable, use that. If you feel public sector is more suitable, depending on the scenario given, the examiners will not tell you. Okay, so now the Boston Consulting Group, that is known as BCG matrix. Okay, in BCG matrix, this is how the portfolios, the matrix is divided. Okay, it is a 2 by 2 matrix. Okay, that means the two matrices are, one is the market share, the other one is the market growth. That's how they analyze the product or the services or the divisions also, where growth is seen as the best measure of market attractiveness. If the industry or the market is growing, means it is attractive. And market share is to be a good indicator of a competitive strength, how powerful you are. The more market share you have, the more powerful you are. The less you have, the less dominant you are. Now let us go to what are the measurement issues. See, BCG matrix you can use to analyze the portfolio and to see which product is performing well or good on the in the matrix. But to measure using this portfolio has some issues. Okay, that's why when you have to use a model, there are some difficulties which you have to take care of. Like, what is the rate of the market growth? How do you say a rate of market growth is high or low? It's difficult, no? It's very subjective. There is no figure which says, okay, above 10% is high, above. No figure as such. It's very difficult to make a judgment. And from market to market, high or low will differ. Okay, a useful tool for assessing growth is pestle model. If you want to assess the growth of a market, you can use pestle model. Pestle model we have covered earlier. Okay, then another, in the exam scenario, this would be a good tool to use alongside the BCG matrix. What tool? Pestle model. In the exam, you can use pestle along with your BCG matrix to assess whether the market has a good growth prospect or not. Then relative market share. What about the market share? It's defined by the ratio of the market share to the market of the largest competitor. You compare what is your ratio, what is your market share compared to your largest competitor. That's how you know whether you have 5% market share, 10% market share, what is the percentage of market share. So this is your BCG matrix, which I've been talking about. There are 4 quadrants to it: high, 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 low, low, high, and low, low. Okay, so first we'll go diagonal. Okay, where your vertical axis, the y-axis has growth rate, horizontal axis, that is your x-axis, has market share. Okay, so when your growth and your relative market share both are high, it is a star. Okay, then if both are low, it's a poor dog. Where market share is high but growth is low, it's a cash cow. And where market share is low, growth rate is high, it's a question mark. Now we are going to explain each of these 4. In the exam, you're not supposed to draw this matrix. Neither you're supposed to draw pictures like this. It is just for your understanding. Okay? That it has a name. All of this 4 quadrant has a particular name. So when you write about it, you have to mention the name and explain that so product is a star because of this features it has, or it's a question mark. Okay? So now, an organization would want to have the following in a balanced portfolio. Okay, everything you need in balance. You should not have too much of one thing, one particular thing. You should not have too much of stars, not too much of dogs, not too much of cash flow, not too much, sorry, cash cow, or not too much of problem child. It should be a balanced portfolio. So cash cow, let's start with the cash cow. Cash cow is where market share is high, market growth is low. That means you are in a saturated market. Okay, so once in a saturated market means you have enough cash flow. So now you can use it to support other products in the portfolio. Other products means the dogs, the problem child, and the star. You can support. The cash cow can support them. So that's why it's very important in the portfolio you should have sufficient amount of cash cows. Next, stars. Stars also unit of sufficient size. Okay, because this will provide sufficient cash generation when the current cash cows can no longer do so. See, cash cow is market share is high but market growth is low. It's a saturated market. But stars can help cash cow at situations where cash cows is not able to generate as much cash as possible. Why? Because stars already have a growth rate. Also, it has high market share. You understanding? So stars also you need. Third, problem child. Problem child that have reasonable prospect of becoming future star. You will not keep problem child if they do not have any better future. If problem child can become a future star tomorrow, then yes, better to keep it. Problem child is when your market share is low and your growth is high. Okay. And the last one is dogs. No dogs if there is any. Dogs means both are low. But remember, just because you it's a dog does not mean just diverse or just do not keep. No, there are some good reasons why you should retain them, which we are going to cover later when we go through dogs in depth. Okay, now let us go through the decision making aspect. How do you make decisions on a BCG matrix? First, let's start with the cash cow. High market share, low growth. Okay, that means substantial cash inflow is from this cash cow. You should have. That is one feature. Second thing you have to understand is period of high growth in the market has ended. It was earlier facing high growth, high growth, high growth. Once it reached that stage, it's not growing any longer. That means the product life cycle you have to understand. You have to link this with the product life cycle basically, the BCG matrix. That will be able to give you better answer. So in the product life cycle, where will you be? There are four stages: growth, introduction, growth, maturity, and decline. So in your product life cycle, you either might be at the maturity stage or you are starting to declining stage. Okay. So because of that, the market became less attractive to new entrants. Currently, the ones who are there, they can survive. But if a new entrant wants to come, the market, the competitors wants to come, it's difficult for them. They do not want to come. It's not attractive because market is not growing. Product life cycle is almost at maturity and declining. How can they come and compete there, right? Even the existing competitors who are there, they will want to leave the market. They do not want. They are not attractive any longer. Third feature, cash cow products tend to generate cash in excess of what is needed to sustain their market positions. They already have the cash that is needed. Fourth, profit suppose the growth of other company products. Yes. Because cash cow has generated enough cash inflow, they already have that profit. That profit can be used to support other products. And what should their firm strategy? If they want to maintain a strong position in the market, okay, so firm strategy is oriented towards maintaining the product strong position in the market. That means they want to maintain the cash cow so that they have a strong position in the market, because cash cow is going to give them a good amount of cash, so they do not want to divest it or sell this off. They want to keep this. Moving on to the star. High market share, high growth. Star, this type of product may be a later stage of its product life cycle. What does it mean? Initially okay, high share mark, but at stage they will be declining. They will face the declining phase, so they will be at a later stages of its product life cycle. A star, okay, and a star may be only cash neutral. Cash neutral means not too much of cash, not too less of cash. Cash neutral, they have cash. Why? Why do you think a star have less cash and cash cow has more cash? Because large amount of cash may need to be spent to defend an organization's position against competitors. Whatever the cash they have generated, the star, because they are still growing, they might want to use that cash to defend themselves against the competitors. That's the reason why they are cash neutral. Cash is coming also, but they're investing also that cash to maintain that high growth. But for cash cow, it's not growing any longer. So whatever they have accumulated, they have accumulated. Competitors will be attracted to the market, yes, because still they are at high growth. They are high market share, high growth. So competitors will be attracted to stars. And failure to support a star sufficiently may lead to product losing its leading market position. If you do not support a star, leading market position you will lose out on. So if they slip away, they might fall into the problem child. They will later become a problem child. Star will become a problem child. And problem child is not good. Too much of problem child, not good. A star, however, represents the best future prospects for an organization. For future, if you think about future, star is the best. Why? High growth, high market share. Who does not want stars? So market share, either you can maintain the market share or you can increase it further. By how? For the stars, by more price reduction, do product modifications, distribute it in a greater way. As industry's growth slows, star becomes cash cow. When industry growth slows down, the star today will become cash cow tomorrow. Why? Because cash cow means what? Market share is high, but growth is low. So growth rate is now high. If it becomes low, star becomes a cash cow. Now we are moving to the problem child. Problem child can sometimes be called as question mark also. Here, market growth is high, but market share is low. Here, substantial net cash inflow is required. You need a lot of cash here to increase your market share because you want to take away customers from your competitors. You need cash for that in promotion and all those things. So here, the strategy means a company must decide whether to do nothing, to do anything or not to do anything. Okay, but whatever, even if they do nothing, remember, cash continues to be observed. Cash will go because you have to invest so much of money so that a problem child becomes a cash cow. So that you increase, sorry, a problem child becomes a star. You increase the market share. But the question is whether this product can compete successfully. Even if you give them the support, can they compete successfully? And what that support will cost, that also depends. Then we are moving on to the last category, that is a dog. Low market share, low growth. But this one, they tend to have negative cash flow. That is understood. But for dogs, it is unlikely that a dog can wrest market share from competitors. It's very difficult for a dog to snatch away the market share from their competitors because competitors already have an advantage of larger market share. So since they have an advantage of it, economies of scale is there. They can fiercely resist any attempts to reduce their share. If they see that dogs are trying to reduce their share, the competitors will do everything possible, and they can do it because they have the resources. They have enough market share, they have enough contact, market is there. They can do it, right? Next, an organization with such a product can attempt to appeal to a specialized market. Yes, dogs, you might say that don't keep dogs, but sometimes dogs are still kept. Why? Because they can be appealed to a specialized market. Okay, so you have an option here for dogs. Either you delete the product, that means cut off, or you harvest profits by cutting back support services to a minimum. That means whatever the profit you are getting, okay, you cut back the support services to a minimum. Support services that you are getting, cut back on that to a minimum. Now, there are further questions that one needs to ask when they are making a decision on BCG matrix. What are this? Like, which strategies are more suitable to move products from question marks to stars and eventually to cash cows? Okay. In other words, will the strategy move an organization to a dominant position in its market? That's a question. Second, will there be sufficient funds from the cash flow to support the stars? Because many bankruptcies have occurred because firms have invested heavily in the promotion of products in rapid growth. Wherever products are there in the rapid growth industry, firms have invested heavily on those in the promotions, okay, without profitable and well-established products from which it can fund these new ventures. Rather than using the profit of the well-established products, they started investing in the promotions only of those products which are in the rapid growth industry. So they're running out of cash. They became bankrupt. Then, does the portfolio have a balance of activities that measures the range of skills within the organization? Unless a balance is achieved, unless you have the balance of all the four, certain groups will be overstretched while others will remain underemployed. Okay. For example, question marks and stars can be very demanding on a time of management. If you have question marks and stars for the time, on the time of the management is very demanding. They need more time. Why? Question marks, because they have high market growth and market share is low. They want to invest on promotion, things like that to gain the market share. So there they need more time, more resources. Same for the stars, so that they do not become a dog. Okay, so that they can be converted into a cash cow. You need time for this too. Is the organization thinking about an acquisition strategy? Okay, so when ones go for an acquisition, remember the most likely targets for acquisition are not the cash cow and the stars. It looks like stars and cash cow will acquire. No, but it is the question mark and the dogs that one wants to acquire. Now there is a logic behind this, because if you can see any prospect that okay, today it's a question mark, but tomorrow in the future if they get the right resources, they can move to stardom. That means they can move to a star or a cash cow. So they do not see today's position and decide. They think about future and then they take a decision. That's why there's a logic behind why they want to invest in question cows and dogs. Whereas the cash cow and the stars, they already enjoyed whatever they could. They got the success. There is no future for them. At a certain point of time, once you reach the peak, you are going to fall down, no matter what. But question marks and dogs, there's in the bottom, they have a chance of growing up, provided that they get the right resources and the time. So that's why question marks and dogs. Now, we are moving on to the strategic movements on the BCG matrix. Remember, the position is not fixed. Just because you're a cash cow today does not mean forever that product is a cash cow. Position keeps on changing in the matrix because the growth of rate changes, market share might go up and down, right? So, stars tend to move vertically downwards as the market rate slows down. If the market rate slows down for star, it will go down and become a cash cow. And if the cash that they generate can be used to turn problem child into cash, eventually cash cows. Okay, so the cash can be used to turn a problem child into star and then cash cow. See this. This will help you to understand the position better. If you see the dark blue arrows, product movement is the product movement from A to B to C. This is the ideal position, remember. A to B to C. A means problem child, then it becomes a star, then it falls down to cash cow. So this is an ideal position which it goes through. The white arrow is cash movement. That was a product movement. Product was moving. Now cash movement. So the cash in the in the Z. Z is the cash cow. The cash cow's cash you are using for the star as well as the problem child. You understanding? So both the star and the problem child, they are draining the cash away from the cash cow. That's why the arrow is going to X and Y. You understanding? So make sure that you understand this diagram. You will not be asked to draw this diagram anywhere in the exam. Don't worry. Now, how do you evaluate the BCGS strategies? See, whatever the strategies they suggest is just prescriptive. Okay, they say okay, do this if this is in this position, harvest or delete. Okay, so it suggests that all cash cows should be exploited. Okay, everywhere they say if you have cash cow, exploit it, and if you have dogs, dispose it. But remember, this is not always the case. Why? Because some cash cows you cannot exploit. Let's say the market has remained competitive, rivals are not leaving the market, large cash surpluses are not possible. Can you exploit cash cow any longer? No. One example is the New York time. This was classified as what? Cash cow in the BCG matrix, but later it was reporting net losses. So other cash cows, okay, for other cash cows, it may be inappropriate to milk them for cash. If doing so would jeopardize the strategic position of the product or the market mix. If it hampers the strategic position of the product, you might not be able to use. So that's why it is no good of exploiting this cash cow. And then likewise, even for the dogs also we have similar thing. Okay, we say that not all dogs should be removed from the portfolio. Why? Because some dogs you can use as they can give us support to other products. Maybe they might add as a loss leader, whilst other dogs can continue to generate a positive contribution for many years. One example is a major customer. You just have one customer. Okay, so and it requires sales of two products. One is a dog, the other is a cash cow. correct? But if the dog is not supplied, what happens to the sales of the cash cow? You're going to lose it, no? And the business will be much worse off. So to continue with the sales of the cash cow, you should have the dog as well, because he's requiring the product of the dog also as well as the cash cow also. The customer needs both, the major customer. Now, in the examination, what should you do? In the examination, you should not simply state that dogs should be removed from the portfolio. Never do this mistake. Or keep cash cow, remove this, keep them. Don't write such statements in the exam. Avoid. Don't state like that. Instead, what should you do in the exam? You should evaluate what strategy is suggested. That means you have to justify why you think they should be removed or they should be kept. It does not matter. See, your answer, you're not going to, there's no right or wrong answer in SBL. That is one thing. So your marks will not be cut just because you say keep the dog or remove the dog. No. But you have to provide them with justification. You have to give them evidences why you think they should be kept or removed. Argument could go in any way. As long as you support them with evidences, you are going to get full marks. That's it. So before we go to the next portfolio, that is for public sector, let us do test your understanding. Test your understanding 3. Okay. So what I'm going to do is I'm not going to read this entire case study. What you're supposed to do, you have been given 2 drinks. One is orange juice and the other one is pomegranate juice. And you are supposed to analyze its position in the portfolio. Okay. Analyze its position in the portfolio means in the BCG matrix, where does it stand? Is it a cash cow, problem child, star, or a dog? Okay. And professional scale is there for analysis scale. Okay. I'm going to show you how you show the analysis skill. Okay, so if you go by the answer, okay, before going to the answer, let us read some important things. Okay, orange juice. Okay, I'm just going to highlight the important things. They sell in huge quantities, but the margins are low. And this huge quantity did not change for the number of years. It was same. So quantity did not change, margins are low, and they have sufficient economies of scale also. Orange juice. Okay, and if you see the fruity drinks, okay, in the fruity drinks only orange juice, and fruity drink is the industry, by the way. Okay, individual products are orange juice and pomegranate juice. So uh, they are going to have advanced promotion, production and bottling equipment and long-term contracts for future. Okay, now coming to the pomegranate juice. For pomegranate juice, okay, they are producing, but producing the stuff at the right price is a major hassle. Okay, they are struggling. So we hope it will be a winner. What does it mean? Star, right? Once we get the production right and start converting customers to it. So still they didn't convert customers to the pomegranate. Okay, and it is expanding fast. Which what does it show? Market for the exotic fruit juice is expanding fast means they are talking about the growth. So now let us see the answer. If you see the answer, automatically you will be able to tell that orange juice is a cash cow. Why? Because it has economies of scale, quantity was same overall year, and also the margin is low. That means they are not able to earn a big margin right now. Then for pomegranate juice, it is a question mark. Why? Because they were not able to convert customers. That means they are not getting any cash yet. But there's a growth in that market, as we have seen, which the company wants to turn into star, because they told they will be a star in the future. They'll be a winner. They are hoping to see them as a winner. Okay, this much is the answer. Correct? But if you write this in the exam, do you think you will get marks? Let's say this question is for 6, 7 marks or 5 marks. Do you think for 5, 6 marks this much answer is justified? Think. No, it's not. You need the right answer, correct, but you need a way to come to that answer. You immediately cannot write down like this without justifying why it is a cash cow or why it is a question mark. You need to give facts. Okay, so this is not just about the correct categorization, what most students think. Okay, if I am able to correctly categorize, I will get marks. That orange juice is a cash cow, pomegranate is a question. No, it is about the route that you take to get to that answer. Best approach is you have to use the BCG matrix. You have to answer these 4 questions in your answer basically. What are those 4 questions? Whether the market growth rate is high or low, whether the market share is high or low, whether the business, are you using the correct terminology, the BCG terminologies? That means cash cow question mark, you have to write it. Or even a problem child, if you write, it's fine. And then you have to evaluate whether the suggested strategy is appropriate in this case or not. These 4 questions only you need to answer. If you get these 4 questions right, then only you will get your professional skill. That is called as analysis. Now do you understand how do you get analysis skill? You have to go in depth. Obviously, everything you have to go in depth, but for analysis especially more. Now we'll go to the answer. When you go to the answer, divide it into 3 separate parts. One is for orange juice, one is for the pomegranate, and the other one is for the strategy. Okay, so let us see for the orange juice first. So in this, the market is matured and low growth. Okay, how do you know that it's mature and low growth? From the case study, this is the reference, this is the evidence or reference from the case study. You need to reference it like this. It sells in huge quantities, but this volumes did not change over the years. For many years, volume did not change. From the case study is there, it's written there. That's how you know it is a matured and a low growth. Now, you have to link this with the industry. Okay, fruit drinks market share is high. It sells in huge quantities. And market manager is also saying that the company does very well in this market. Okay, so again you can say this would suggest that the product is a cash cow. Again you can suggest through this also that it's a cash cow. Like this, you know it's a cash cow. You are comparing this with the share, the largest share, the market share. Okay, so if you go by the BCG terminology, what does it say? What should you do with a cash cow? They say you have to exploit cash cow. Can you exploit cash cows in this case? Yes, you have to exploit cash cow in this case to support the fruity drinks other products. How do you know that you can exploit? Because remember, fruity drinks have a long-term contracts. They with the number of supermarket chain. They have built up bottle production and also long-term contracts they went. That means they have a future. They have a plan for the future. They do not want to exit the market, right? Fruity's investment in advanced production and bottling suggest, you see how you are giving evidences from the case study, because they're investing in the production and bottling suggest that they are unlikely to exit the market. That means they will be in the market for the future. So having this cash cow till the future will help them for the other products like orange juice. They should be used to support other products such as pomegranate juice. Orange juice is cash cow. Cash can be used to support a problem child, that is pomegranate juice. Now let us see for the pomegranate. Okay, pomegranate juice is not there. This is only written for the cash cow. Sorry, the orange juice. Similar way you can write for the pomegranate juice also. Okay, now let's see. So in this, answer is more detailed. You have shown a better understanding of the model, that you understood the BCG model, and you use the scenario also in a better way with reasoned and justified opinion. You only need this much to get the sufficient marks in the exam. That's it. You understanding? So that's it. And now let us go to our next portfolio, that is public sector portfolio. The public sector portfolio metrics. This is the next type of portfolio metrics after BCG matrix, and this is applicable for public sector organization. Okay, so the two matrices are value for money and the other one is desirability of the service. Okay, value for money means how effectively the services can be provided, and desirability means what is the public support and the funding attractiveness. Can they fund it? Do they have the resources to fund? Now, so this is the public sector portfolio matrix. This is how it looks like. Here also we have high, low, and the 4 quadrants are there. So when your public effectiveness and the value for money both are high, it's a public sector star. Same like how in a BCG matrix when market share and market growth was high, it's a star. Here it's a public sector star. Okay, so this is the easiest way for you to remember. Most of the time, like I have not seen a question where this portfolio came, but that does not mean that for your exam it might not come. Okay, exceptions are always there. Then when both are low, It's a back drawer issue. You must discontinue. It's like dogs. Okay. And when your value for money is high, but effectiveness is low, it's a golden fleece, and value for money is low, but public need is high. It's a political hot box. Let us go in depth in all this four quadrant. Starting with the position, public sector star. What is the characteristics? This are those which are attractive to the public as well as they are well funded. Okay. Strategy is you have to continue with this. Okay. Whatever the funding level is, at the current funding level, you have to continue with the public sector star. Then we have golden fleece. Golden fleece is effective, but the public believe that it is overfunded. Okay. So you can move this fund to other services. Basically, you can aim to reduce some services or cut the staff so that you can reduce the cost in this sector because it's effective, but public does not need it so much. You understanding? The public need is not so much, but it's effective. Then we have back drawer issue. They are not effective as well as they are not desired by the public also. So remove the service. And then we have political hot box. Political hot box is very popular, but they are not very effective. Public needs it, but at the moment they are not very effective. The public sector are not very effective at giving it. They need funds. So this is putting a drain on the funding that could be used elsewhere. Okay, so what is the strategy should be? Either you can change the public's perception and change it to a back drawer issue, or you can improve the effectiveness by providing extra resources and turn it into a star. You can go in either direction. So you can lobby for more funding. You understanding? Now, there are some problems with this matrix as well, how we had issues with the BCG matrix. What are the problems like? One problem is how do you apply this? Because the dimensions are all subjective. High, low, and it depends on the user's perceptions also. What the body should be doing, what the public sector is good at doing. You never know exactly what they are good at doing or what they should be doing. Next is some public services are mandated centrally. You cannot remove it. One example is advertisement of job that are provided at the employment sector in many different languages. Okay, they may be provided in many different languages. There's a difficulty to do this task. So because it's difficult, it might lead to inaccuracy, it's expensive to achieve. Okay, that means you are struggling to provide value for money. Here, you cannot give value for money. Understanding? By giving the service. But it may not be desired by the public also. But so this would make it a back drawer issue because it's not demanded by the public. You are struggling to provide value for money. It's a back drawer issue. Which usually what happens? You will be abandoning it, right? By the employment center. But this provision of this service might be a part of a legal requirement. What if it is? That is set by the national government. In that case, you cannot remove it. You have to continue with it. Okay. Next. So that's it for the public sector portfolio. Now we have the third portfolio, that is a Ashridge portfolio display. Okay. This is also not a very common, does not come frequently like how BCG matrix comes. But as I told you, you should always be prepared for the worst. Okay. This portfolio is Another word for this portfolio is parenting matrix. This focuses on the benefits that a corporate parent can give to the business units or they can give to the subsidiaries. Okay, as we know, sometime back we studied corporate parenting. There we told that either they can add or destroy value for the strategic business unit, SBUs. Okay, this matrix considers two particular questions. What are those two particular questions? Number one, how good is the match between the parenting opportunities and the parents' skills? Okay, one is your opportunity, one you should have the skill also. Sometimes you might get the opportunity, but you don't have the skill to act to it. Sometimes you don't have the skill, but you have an opportunity. Next is how good is the match between the CSF, that is critical success factor of the business unit, and the skills and the resources that parents can bring. Not understanding? It's okay. We'll understand it better with the diagram. Okay. If you see all the portfolio displays are like this only. You'll be having high-low in both the matrix, both the axes. And then you'll be having four quadrant with a name on it. You should know this name. Whether it is a public sector, whether it is a BC matrix, whether it is an Ashridge portfolio display, don't get confused with the names. Sometimes what happens is BCG matrix you might come and put in the Ashridge portfolio display. Like dogs, cats count, don't do that. Usually it does not happen, but I'm just giving you a warning that in case if it happens. So here also, one is ability to add value from the parent side, the other one is opportunities that parents have to add value. So if both are low, it's an alien territory. Okay, you can say alien. If both are high, it's a hard land. Hard land. Okay, and if ability to add value is high but opportunity is low, it's a blast. And if ability to add value is low but opportunity is there, it's a value trap. Okay, now let us go in depth what it means. Heartless business where both are high. What does it mean? You have a high degree of match. Okay, where the parent has the capabilities also to add value, and they can actually add value because they have the opportunity also by giving their support. Next, this businesses should be central to the future strategy. This you need it. You need Heartland because they are central to the future strategy. They are very central, very essential. You cannot forget this. You cannot leave it. Then we have blast businesses. Okay, here these are those where the parent understands the business well, but there are limited opportunities to offer help. Okay, maybe because sometimes the business has been owned for a long time and no further support needs. They do not need any further support, but parent understands the business well. And this businesses would do better if left alone or indeed divested. So this type of business where parents cannot offer them need, but they understand the business well, better to leave them alone or divest them. Okay, remember the strategies in every quadrant. Next, we are moving to the value trap. This are those that appear where parent opportunities are there. Okay, but it's a poor fit with the critical success factor of the business. Okay, opportunities are many, but it's not a good fit with the critical success factor of the business. Okay, and there appears to be a good potential, but in practice, because of the lack of fit, there's a high possibility of destruction of value. This value trap means destruction of value only, in short, because it's not a good fit with the critical success factor. So even if you try to do it, even the potential is high or good, it will destroy the value at the end. So you should not go for it. And finally, the ADN business. These are those where there's a complete mismatch, and this should not remain the part of the corporate portfolio. Okay, now using the Ashridge portfolio indicates which type of company should be divested and why. Businesses may be candidates for de-investment. These are the businesses which you should de-invest. Number one, alien business. Why? Parent cannot do any good to these organizations, so they would achieve more in another group rather than staying in this group. Disinvest them. Next is value trap business. This also disinvest. Okay, even though they have the potential, but it's a lack of it. So loss of value is high. Third is blast businesses. They may do better alone. Sorry, they may do better as the parent has little to offer. Parent does not have so much to offer, so they can do better alone. This three type of business are the candidates for disinvestment. But only the heartland business you have to keep. You cannot disinvest that one. Okay. Now we are moving on to that only. So the matrix has expanded and now it has introduced a new term known as edge of a heartland business, because you can see an edge in the diagram. Diagram and all is not so important, but just understand there's an edge, right? We'll explain what it means. Okay, so the edge of the heartland business unit. Okay, these are those where there's a good fit in some area where the parent can bring particular skills and that can add value to the business unit, but not in other areas where parents may destroy value. So partly they are bringing benefit to one, partly they are destroying the value to the other one. That is the edge. Okay, the two edges. And however, if the parent develops sufficient understanding of the business, parents, what can they do to bring the benefit overall? Develop sufficient understanding for the business. Okay, then the business may move into the heartland. From the edge of the heartland, they may move to the heartland where both are high, both are good. Understanding is also good, opportunity is also there. Understanding. So that's it for portfolio analysis. Now let us do one test to understanding, the last test to understanding 5 before I conclude this lecture. Test your understanding 4. Okay, so here you have to label the different business unit according to the Ashridge portfolio display. What does it fall under out of the 4 quadrant? This is going to be a little challenging, okay, as you are not so much familiar with this portfolio. It's a new, but we'll make it a try. Okay, Anodhi started as a single restaurant and has developed into a large quoted fast food provider. Over the last 10 years, it has diversified as follows. Okay, so they're into the fast food and they're into the single restaurant. Trendy hotels, commercial property development, a depressed market at the present, and jeans manufacture. Okay, one is hotel, one is commercial, the other one is clothing. Main skill of the parent company holds lies in identifying consumer trends regarding food and designing menus to match those trends. Okay, now you know the skills and the opportunity for the parent company. So what do you think the trendy hotel will be? It will be Heartland. Why? Because they have the experience, they have been in the restaurant and the fast food provider. So trendy hotel. Okay, we'll see the answer. If you go through the answer, sorry, the not the hotels, the fast food outlets. Okay, just wait a minute. Why fast food outlets came? Okay, they have taken the fast food outlets also. Okay, so fast food outlets are heartland. We know that, or it could be a blast also. Regarding whether they have opportunities to exist for value to be added. Okay, if both are high heartland, if one is low, then blast. Coming to the genes and property development. These two are alien. Okay, why for genes is alien? Because they're in the restaurant, they cannot add value, neither they have any opportunity to add value for the genes. Or possibly they could be at the edge of the heartland if you believe that skills can be transferred to identifying consumer trends. If see, parent have a skill in identifying consumer trend, so if they can transfer that trend to genes also, yes, you can say that they could be at the edge of the heartland in clothing as well, because currently they have in the food. Otherwise it's an alien because they're totally unrelated, so they cannot add any value, neither they have the opportunity. Coming to the property development, that's the same thing, because if you see it's a depressed market currently. Now let us go to the hotel. Hotel is a value trap. Why? Because head office may believe that it has more skills to add value on the food side. Correct? But in reality, the CFS are more concerned with marketing, staffing, and cost control. Hotel has more than food. It needs staff, it needs marketing, it needs cost control. So your critical success factors are in these 3 areas. So it's not matching with each other. You see, you have skills in the food side, but it's not matching with your CSF. That's why it's a value trap. Hotel. Okay. But answering this much, like how you have answered for BCG matrix, that orange juice was a cash cow and the pomegranate juice was a problem child, is not enough. Okay. Same, it has to be in relevance and depth. This answer which just now we went through is not in depth. So you have to have a separate evaluation for each business unit. For all this 4, separate evaluation. Okay. Answer is not given to you, but they have told on what you need to comment. Okay. Let us go through these 4 bullet points before we conclude this lecture. You need to comment on the opportunities to add value. Do they have any opportunities to add value? Who? The parent. Okay. That means you have to discuss the problems and issues being faced by this business unit, whatever the issues they are facing. Then you have to comment on the ability to add value. Okay. Then how you have classified in the parenting matrix. That means the Ashridge portfolio matrix. That you have done correctly. Alien, Heartland and all. Then you need to evaluate whether the suggested strategy is appropriate in this scenario. What is the suggested strategy? That you have to do disinvestment of the other 3 except Heartland. Is it appropriate in this scenario? You have to comment on those things in your answer, but full answer is not given. Only this answer. The classification is given. Okay. So now let us go to the conclusion. Okay. So let us summarize. Okay. Methods of strategic development. Okay, so we went through the development methods. We started with acquisition, organic growth, joint venture, franchising, licensing, business partnering. Then we went through portfolio analysis. The three portfolio analysis are BCG matrix, public sector portfolio matrix, and Ashridge portfolio display. So that's it for this lecture, and we have with this we have finished our section C strategy. So thanks for watching and see you in the next section. Next lecture will be starting with a new section, section D of your SBL syllabus, that is risk. So till then, thanks for watching and see you in the next lecture.